Hi, everybody, and welcome back to Chapter 22 in our second video. And when we left, just to refresh your memory, um, we showed that the camping department here had lost $5,000. On the surface of things, you might say, hey, we should get rid of the camping department and only focus on hiking and go from 19,000 to 24,000. That would be poor reasoning. Let me show you why. Here, our departmental contributions to overhead equals our sales minus cost of goods sold and direct expenses. And from that, we're going to get contribution to overhead by department. That performance measure is going to be based on controllable costs. So here we've done just that, departmental contribution for hiking and camping, and it shows only the cost of goods sold. That gives us a direct profit. Our direct expenses, salaries and depreciation, and direct expenses. And that says that hiking is contributing the lion's share to overhead, but the camping department is kicking in about $8,400 to that effort as well. So yes, we should keep the camping department based on these numbers. Okay, let's take a look at investment centers using return on investment and residual income. So if I have two investment centers, an LCD and a phone, these investment center managers are responsible for revenues and costs and for the investment in the operating assets. Here's our average assets for both. So you can see there's quite a little difference here in actual income. But there's also a little bit of difference in the assets that these investment centers utilize. So how do we calculate return on investment? We take our income and divide it by our average assets. So our income coming back, here's our income. And we divide that by our average assets. And as you can see, our return on investment is 30% for the LCD and 20% for the phone. So residual income is that portion of your income that exceeds your target income based on a percentage of average assets. So let's see how that works. Here, we want to make 8% of average assets. So that's going to give me my target income. And I'm going to take 8% of 2.5 million. That gives me 200,000. And then for the phone division, I'm going to take 1,850,000 times 8%, which gives me 148,000. So I subtract those target incomes from my actual incomes, and that is the residual income for these two divisions. 550,000 for the LCD and 222,000 for the phone division. Okay, if we look at investment centers using the profit margin and investment turnover, we would need to calculate return on investment. And how do we do that? We take our sales, our income, and our average assets. We need all of these. So our profit margin is going to be our income divided by our sales. This should be net income and net sales, but they've abbreviated it for effect here. So the LCD is making 8%, phone division's making 5%. Investment turnover, we're going to take our sales and divide that by our average assets. And our turnover for LCD is 3.75, but phone is doing a little better at 4. So here's an okay. So in that sense, we can evaluate them based on profit margin and investment turnover. So our profit margin times our investment turnover will give you your return. So, all right, I think that's clear. Now, if we look at the balanced scorecard, here, this gets to be, in the real world, fairly elaborate to analyze properly, because we're looking at 4 different perspectives: the customer perspective, internal processes, innovation and learning, and then financial. So a lot of that, they've broken it down here between the pieces of those 4 areas. And so if we're going to do balanced scorecard, we need to collect information on the key performance indicators within each of those 4 perspectives. Now, transfer pricing and methods to set transfer prices. Let's take a look at that. Transfer pricing can sometimes be a sticking point with some managers, because they have options to purchase that same product from outside the company. So a transfer price is the price we use to record the transfer of goods across divisions of the same company. So she's saying, hey, my department loses money if my transfer price is less than $30 per screen. Okay, that's because her cost, or variable cost per unit, is $30. But the phone manager says, hey, I won't pay more than $80 market price to buy this from the LCD, because I can buy it on the outside for $80. So the difference between $30 and $80 is going to be the negotiation range. And a lot of people do that differently. I have my own prejudices as to how to do transfer pricing, but I'll let you be the judge of how you might do it. But I think this slide does a good job of showing that negotiation range. All right. In this case, if there's no excess capacity, that changes the numbers a little bit. The LCD division is producing and selling 100,000 units to outside customers with no excess capacity, and that is, they get $80 for those LCDs, and they don't have any excess capacity to manufacture more. So they can sell that to outside and not worry about the inside sales. So with no excess capacity, the LCD manager, she's not going to accept a transfer price less than $80 per screen, because she can get that on the open market. That's the market-based transfer price. Now, if there is excess capacity, then it's a little bit different, because the LCD division is producing and selling less than their capacity. And so the transfer price then is going to be something between $50 and $80 or something like that. At a transfer price greater than $50, the LCD division can cover variable cost. That's a cost-based transfer pricing. A negotiated price, of course, between the variable cost and the market price is called the negotiated transfer price. And that's usually where the chief financial officer needs to step in and make the decision. Okay, computing the number of days in the cash conversion cycle. Here we have the cash conversion cycle is going to be how much average time it takes to convert the cash outflows into cash inflows. So your days sales in accounts receivable plus your days sales in inventory less your days in payables. So in that case, we would need to calculate the days sales in accounts receivable and inventory and payables. And those are the formulas for calculating that. Again, we're talking net receivables divided by net sales, inventory divided by cost of goods sold, and accounts payable divided by cost of goods sold to get the days in those three categories. We add those all together. Well, we add the days sales and receivables, the days sales and inventory, back out the days in payables. And that will give us our cash conversion cycle. Obviously, we want the fastest conversion possible. So here's where we would look at that a little bit. In the current year, we're 33 days and 54 days for inventory and 77 days for days payable. So we would add these two together. That's 87 days minus the 77 days payable, and that gives me 10 days. But the prior days, I did it in 8 days. So that represents a deterioration of our cash conversion cycle. All right, let's take a look at describing the allocation of joint costs across the products. So as we move to this slide on joint costs and their allocations, now we're getting into a little bit of cost accounting. These joint costs are incurred to produce or purchase two more products at the same time. So the example they're going to use is a dairy company, and they have joint costs to produce the raw milk. And then once they've produced that raw milk, then they split it into its joint products, whole milk, 2% milk, 1%, and then skim milk. And this is the split off point here where the raw milk is used for that purpose. So how should those joint costs be allocated to different products? Here, the joint costs of the dairy company include the milk at those various components, and the joint cost of 30,000 then is going to be allocated to the different products based on the sales value of each product at the split off point. So here's the sales values, 50,000, and the percent of the total, the allocated cost of 30,000, and the gross profits. So now we can allocate that based on those percentages. And that concludes Chapter 22. And when we return, we'll talk about Chapter 23. Until that time, bye for now.